Okay, good morning, everyone, and welcome to our second event of the week, this Coffee Microcaps morning meeting for Friday, the 6th of September. You're all very welcome. For any of our new attendees, you're very welcome. My name is Mark Tubb, and I'm the founder of Coffee Microcaps. And for all our regular attendees, you're all welcome back to this morning's session. I'm just going to run through a couple of intro slides here quickly, and then we're going to get into it with the first of our four presenters this morning. I would like to mention RAS Research as a Service, our sponsor here for all our online events at Coffee Microcaps. If you are looking for some small and microcap research, please do check out their website. They've got a whole plethora of names that they cover there, which you can download for free. Quick compliance and disclaimer slide, and a warm welcome to any of our friends from ASIC here this morning. For anybody who is joining us for the first time, the companies we generally have presenting on here are capped under 300 million. Our definition of a microcap are in revenue, generally trending towards cash flow break even, or indeed are already profitable. We tend not to have companies from the resources and biotech sectors on here. What I like to call industrial microcaps, which kind of covers everything else outside of those two sectors. Structured this morning's webinar, we've got four companies, so a full deck on here this morning. Each presenter will get 30 minutes, which we'll break into roughly 20 minutes of a presentation and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier to moderate the questions. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel next week. You can follow us pretty much on all the socials. Twitter is our main one. YouTube, as I said, for the recording of this webinar, and indeed yesterday's one. And we've got well over 100 webinars up there now, so plenty of ASX microcap content on the YouTube channel. LinkedIn, we're also on there, and I do write a monthly newsletter that goes out on the Substack platform. We will shortly be joined by Peter McGrath from Comms Group. After Peter, then we're going to have the team from Quickfee join us. And then we'll be welcoming back Paul McDonald from IDT Australia. And then finally, joining us for the first time here on Coffee Microcaps, we'll have James Beeson from Earlypay. But that is enough from me. I'm going to stop sharing my screen and I'm going to hand you over to Peter McGrath. Peter, welcome back. Thanks again for joining us here at Coffee Microcaps.
Thank you, Mark. It's a pleasure to be here.
If you can start sharing your screen, Peter, I'll let you know once it comes up. Yeah, I can see the cover slide of your presentation deck now, Peter. You can take it away.
That's great. And thanks once again. And thank you, everyone, for attending this morning. We're very excited to run through our results for FY24 and some of the key drivers. But behind those results, we're very pleased, I think, with where we got to this year. It's a culmination of a number of years' work within the business. So firstly, we do get asked by a few investors, who are we, what do we do? So I'll quickly run through that with an introduction. So we're a specialised cloud communications and managed IT service provider to businesses. So we have a focus on B2B. We don't focus on consumers at all. And we have the latest, most modern unified communications and ICT solutions for businesses, focusing on things such as hybrid working, unified, meaning, for many businesses, this is their point of contact for their customers and suppliers, and also security, which is very important today. We were listed on the Australian Stock Exchange in 2017. We have made a number of acquisitions over the years. We're very careful with our acquisitions. We want them to fit well into the business, and we want to obviously be able to extract synergies. We're headquartered in Sydney, Australia, where we have our main operations. We also have operations in Melbourne, the Gold Coast, Singapore, London, and the Philippines. And across the Asia Pacific, We've focused in the last few years on extending our reach into many countries where we have a license to operate. Some of our key customers are typically businesses, small businesses, medium businesses, but also enterprise, government, particularly local government. We also sell wholesale services to domestic and international telcos and IT service providers. So one thing you'll see when I present in a few minutes is we have quite a lot of key technology and a advanced voice network that's within Australia and internationally. One of the things we focus on is cash generation and generating strong shareholder returns. We typically focus on also generating high gross margins. And we have three key divisions that we operate within the business today: our domestic cloud communications and collaboration business, which is really for domestic SME and corporates; our secure modern workplace solutions business, once again for domestic corporates; and then our global unified communications for global enterprises, and also wholesale voice services for global telcos and large application service providers. These are businesses that sell their services globally, and they need to buy local voice and collaboration services within market, and we provide those wholesale. I will elaborate a little bit more on that shortly. So FY24 has been a significant year for Comms Group. We reported record revenue and EBITDA. Our total revenue was 55.5 million, which exceeded guidance, and our underlying EBITDA was 6.6 million, which was in line with guidance. Importantly, for Comms Group, over 90% of our revenue is recurring. So we're not reliant each year on going out and having to sell a lot of one-off hardware, etc. Most of our revenue is from services. We have a strong focus on cash generation, and this focus has seen operating cash flow increase 150% to 3.8 million, and free cash flow increase nearly 200% to 3.5 million. So you'll see this shortly when I present that, but our free cash flow is after CapEx. New sales contract of 7.5 million in new annual recurring revenue. As mentioned before, we typically like to focus on recurring revenue, with many of our contracts being 3 years plus. And we have a strong, consistent level of new sales, typically quarter on quarter. So we're not reliant on one big quarter. We typically have, a strong level of recurring or new sales contracts being signed each quarter. We also focus, besides, the SME and the corporate area, we do have a number of key strategic accounts, and one of those is Vodafone Group PLC, where we are the global provider of key unified communication services. We have circa 6 strategic accounts. And this is where we provide these organisations key building blocks, typically high-end unified communication services in many countries, predominantly in the Asia Pacific, but beyond that as well. We want to focus on these key strategic accounts as well as our day-to-day business. And these strategic accounts for us typically bill greater than 100,000 per calendar month. We want to generate more of these strategic accounts over time and make sure that we focus on them and service them well. I mentioned earlier that we've made a few acquisitions over the years. These acquisitions have all been very successful. And with the synergy extraction and the cost reduction that we've focused on with these acquisitions, we've been able to deliver an overall group gross margin of 47.5% within the year. Now, if you think of that compared to some of the NBN providers out there who tend to focus on NBN more so, they're generally getting margins around the 30 to 40%. Our margins are up close to 50% for this, across the board for all the services we sell. So we're really delighted with that level to be able to generating circa almost 50% gross margin. We spent quite a bit of time over the last 18 months, 24 months, focusing on getting voice licenses in key countries in the Asia Pacific. Why do we want these? So that we can then provide services to multinational corporates typically, and also wholesale customers in many countries, not just in Australia. We've had a strong focus outside of Australia for many years. We were one of the first to deliver Microsoft Teams calling globally, particularly in the Asia Pacific region, launching that in August 2018. So this is building upon that thematic. We want to get these voice licenses in these countries, and we have a right to operate them. And really pleased to announce this year our inaugural dividend of 0.25 cents per share. That was declared in August 24. That's fully franked, and I'll cover the details on that shortly. A little bit more about what we do. So one of our, the key things we want to do with the businesses that we have on board as customers is we want to make their businesses more competitive as well. We want to help them to be more competitive and more agile. And so our services are predominantly cloud-based, both communications and secure modern workplace solutions. That first area that I talked about a little bit earlier, our domestic cloud communications and collaboration business, is a service provider to Australian SMEs and corporates with award-winning customer service that's branded under the Next Telecom name. And it provides a full range of services. It does provide connectivity services, NBN, fibre as well, but we tend to focus on some of the latest generation services that are going to make a difference to our customers. So unified communications, so our customers can work from home or wherever they might be working, on the road, travelling, etc. They're still able to communicate fully and securely with their suppliers, their customers, their business partners. Secure Modern Workplace Solutions is an award-winning IT and cloud services managed service provider supporting corporate customers' ICT needs. So more and more businesses are saying they want a secure environment to be able to operate their business. They cannot take risks with hacks and receiving emails that might have viruses in them, etc. But not just that, they then want the whole solution to work seamlessly and knowing that their documents and their customer information is secure. So there's a focus within that business. So many of our smaller and medium businesses are now saying, I need a professional, secure modern workplace solution. So we have a strong competence in that area. And then finally, our global unified communications and wholesale business, where we're a specialist unified communication solution provider for international businesses. So they may be Australian multinational companies that operate offshore, banks, large industrial companies. And we also have a communications platform as a service business where we provide key platform services for wholesale customers. We have a number of significant global telcos who take our services, particularly in the Asia Pacific region. Rough breakdown of revenue, we'll see that in a moment, but the first two businesses, circa 24, 25 million. The middle business there, around about 20 million, and then the global unified communication and wholesale, 13, 14, 15 million of that order. A little bit more on who we are, and then I'll move into some of the financial results. So Comms Group is a key provider of unified communication solutions to global businesses. Example of some of the products there is Microsoft Teams calling. So if you have a global business across the region or internationally, we can provide you that Microsoft Teams calling experience in every country that you operate. And in many countries, as I mentioned before, in Asia Pacific, we're fully licensed now to do that. We would be the most licensed provider, I dare say, or at least right up the top there with our own licenses across the Asia Pacific region. We also provide wholesale voice services, and these are things like SIP trunks, telephone numbers, the ability to make and receive calls locally within country across the Asia Pacific region for global telcos and over-the-top providers. And some of these are communications platform operators in their own right or communications centre as a service provider. So the top 10, if you like, contact center, providers. We have a number of those within our customer base. Our goal is to continue to work hard within Asia Pacific and become a leading provider for both CPaaS for the wholesale market and UCaaS for the multinational enterprises operating there. And within the year or within the last 12 or 18 months, we've now secured licenses across Australia, New Zealand, Singapore, Hong Kong, Indonesia, Japan, Malaysia, and Philippines. We're very close with our Taiwan license. And then in China, South Korea, Thailand, and Vietnam, we have partnerships in place with key providers in those markets. In terms of the products and services that we sell, that's included within an appendix within the pack. I didn't want to go into that in detail, but we do have some investors who ask us that question regularly. Can you give me some examples as to what you sell? And you can see that in the pack at the end. We'll just move now to financial highlights. In terms of the key highlights, we delivered solid growth in revenue and EBITDA and a significant improvement in operating cash flow and free cash flow. You can see there our revenue was up 7% to 55.5 million. Our gross profit was up 9% to 26.3 million. And our underlying EBITDA was up 36% to 6.6 million. And really pleasing on the cash flow side of things, our operating cash flow was up 153% to 3.8 million. And you'll see with operating cash flow in a moment that we include a number of expenses that others probably don't put in their operating cash flow. And then our free cash flow was up nearly 200% to 3.5 million. Importantly on this, our revenue growth was basically all organic, not from any acquisitions or any strategic initiatives. It was really from organic growth within the business. So I mentioned there a strong increase in revenue, GP, and underlying EBITDA, and you can see the year-on-year results here at gross margin as well at 47.5%. So that was up. So we're very pleased with that. Our operating expenses were held largely flat despite the pressures that we're seeing and the fact that we've added additional resources within the business. Particularly in our global sales and operations position. Our overall revenue also increased from half one to half two, and our EBITDA also increased from half one to half two. This shows our financial performance over time, and you can see that, going right back to FY20, we've had, good, strong, consistent improvement in overall operating revenue. And you'll see there that our second half was stronger than our first half as well within FY24. Our secure modern workplace solutions business, which operates predominantly in Queensland and Sydney, and also now with resources in Melbourne, had a particularly strong year. And we're seeing strong interest in our best-of-breed hybrid cloud and managed ICT and our enhanced security solutions. We have a modern workplace solutions offering for corporate customers, which covers all the key requirements that they need, and particularly strong in the security area. Our cloud communications and collaboration business was able to maintain revenue despite market pressures, and with an increase in the second half from a major client win. And our global and wholesale area saw growth in the year with an additional revenue secured from a Vodafone key account. One of the key focuses within our business as well is to increase the cross-sell of secure modern workplace solutions to existing telco customers, and that's one of our key synergies we see going forward. In terms of our gross profit and our underlying EBITDA, you can see the trends there. Once again, good, strong, consistent growth over time. We continue to focus on managing and rationalizing supplier costs. We've continued to see good, strong growth, particularly in our secure modern workplace solutions in the EBITDA area, but you'll see that across the board. And all business units demonstrated a growth in gross profit and EBITDA within the year. Our cash flow table here, particularly pleased with the results that we saw with our underlying operating cash flow up 52%. Our operating cash flow, which is after income tax and after lease rental payments, up 150% to 3.8 million. And then you can see we are a CapEx-light business, and that's one of the key attributes of this business. We're not going out and reinvesting or spending more on CapEx each year and significantly impacting our cash flow. What we're seeing is strong operating cash flows and also then a strong free cash flow position. So free cash flow was up 190%, nearly 200% to 3.5 million. And as a result, we had a strong increase in overall cash within the year. On the balance sheet side of things, you can see there the cash at year end was 3.6 million. We have a loan facility with CBA drawn to 7.6 million, and that's been renewed until August 2026. But across the board, a strong balance sheet. In terms of the dividend declared, really happy with this inaugural dividend that's been declared. Key focus in the business is cash generation and generating strong shareholder returns. So the reason that we want to generate strong gross margins, the reason we want to be focused on our supplier costs and our OPEX is ultimately we want to generate strong cash and good returns for shareholders. So we're really pleased to declare an inaugural dividend of 0.25 per share that is fully franked as well. And we've also introduced a dividend reinvestment plan that will be in operation for the inaugural dividend. That's currently being finalised, and shareholders should be receiving that notification. I think it went out in the last couple of days. Key dates as follows: ex-dividend 27 September, record date 30 September, and the dividend expected to be paid on the 16th of October. We'll just finish up now with a couple of slides on strategy and outlook. And so really our strategy is to become a leading cloud communication, collaboration and secure modern workplace solutions provider across the Asia-Pacific region. So we want to leverage the strength that we have domestically and take that selectively into the Asia-Pacific region, obviously with strong creditworthy customers and also with key partners of ours. So domestically, we have a strong focus on the corporate mid-market sector. We want to cross-sell more of these secure modern workplace solutions to our customer base. We have a strong partner program. We're keen to grow that and expand that. And also the strategic accounts I mentioned earlier, we want to add more accounts and sell more products and services to those accounts. This strong Asia-Pacific footprint with unified communications that we've put in place, we want to leverage that with some of our collaboration and secure modern workplace solutions to MNCs within the region. A couple of other things we're focusing on, obviously, is strong cash flow and improving shareholder returns. Working on standardizing some of the systems and platforms across our business so we can be seen more as one business for our customers. And then also we'll look at strategic growth opportunities with acquisitions to increase our scale and add additional capabilities. Our group outlook, we're targeting group organic revenue growth in FY25 of 5 to 10%, and underlying EBITDA target of greater than 7 million. We also importantly want to see an increase in operating cash flow and improvement in free cash flow conversion to generate strong shareholder returns. And as mentioned, we will explore strategic growth opportunities. If you have any more questions, you can contact us via our investor section of our website, which some of the details are shown there, but very happy to take questions on board now.
Thanks, Peter, for giving us that update. We had a few questions come in there, so we'll try and get through them all here. First one is on the on Platinum business. It said customers dropped by 20% in FY24. I'm not sure if it was in the more extensive results deck, but ARPU increased 43%. Can you provide a bit more nuance to that change? Is that some low margin customers and business has dropped off there, or?
Yeah, look, there may have been some, the way that we calculated our customers might have changed, but I don't think we saw any real change in the number of customers there. We'd need to look into that and come back to that person. We do see, a minor amount of churn, but probably our secure workplace solutions business is probably got the lowest churn across the board. We typically have longer contract periods, and they're multi-year contracts. Obviously, you'll see one or two move on over time. They might be acquired, etc. But in general, that's a very secure base. We had some great wins in the year, and you'll see that our revenue increased quite a lot within that business. We see that business, tracking with increases over time. We're generating strong gross margins of about 50% within that business. So we're very happy with that business, delighted with that business. And if we could see some more businesses like that, we'd be very keen to acquire them.
That leads nicely into our next one. A question on M&A strategy more broadly, companies you're looking to acquire, and what have these companies kind of been bought in the past, where you have done acquisitions in the past? Maybe just touch on those.
Yeah, so briefly, with some of the acquisitions we've made in the past, we've made some acquisitions within our communications and collaboration space. So that's given us greater scale there. And also, we've been able to extract significant synergies there and improve our gross margin. And hence, that business is around about a 23-24 million turnover business. Not a lot of those left in the market now of scale. We're finding within the corporate sector, the mid-market, we want to get greater capability and greater scale within that secure modern workplace solutions area. We generate strong margins within that area, as I mentioned, and good term contracts, and it's very synergistic with the other products and services that we sell. Mid-market corporates and above are all focused on putting in, unified communication solutions and secure IT environments. So that's where we see some great opportunities in the marketplace. I think more generally, anything that gives us some more capabilities and skills, whether it's product, whether it's additional customers within that mid-market corporate area, I think we'd be keen to look at those.
And then in terms of revenue in the business overall, how much of it would you say is kind of on contract, locked in for the current year with some kind of, annual pricing update or review versus, we've got to win and deliver projects here to get the revenue in? Maybe just give us a split across the.
Yeah, so we did have a strong fourth quarter in FY24 of new sales, and obviously that takes you 2, 3, 4 months to deliver those customers. But that's kind of standard for the business. Quite a lot of that revenue is secured. I think we mentioned right up front, or I mentioned right up front, that over 90% of the revenue is typically services and recurring revenue. It's not one-off deals. So, in general, we got a strong recurring level of revenue. And as we win more and more contracts, we should be able to add to that. So we're not that type of business that each year needs to go out and try and win the revenue again. We're predominantly a services-based business.
Okay. And then, yeah, just on the margins, you touched on that, you're higher than what a lot of the NBN providers and resellers would be. Given that the mix of business contributions is changing, should that margin kind of still stay around the same, or is the secure workplace business, is that a higher margin that should increases its share within the three, start to push margins up more, or just
Look, it would be very nice for us to see margin increase over the next couple of years. We're at just under 48% today. It's obviously something that we will focus on. But we don't have any specific goals to see margin go up to, say, 60% or whatever. But there's no doubt that secure modern workplace solutions, is generating around about the 50% gross margin. So that's a very good business for us. So if we have more business in that area, yes, the margin should tick up a little bit. But when you're up around the just shy of 50% gross margin, it's not that easy to keep on kicking your margins up. But we'll see how we go.
Yeah, I was just coming out more from the angle of, with the changing mix, how that was affecting margin.
Sure.
I just want to touch on one last question. Is there now a formal dividend policy from the board? We don't typically see too many microcaps paying a dividend, so it's great to see another one added to that list. But I just wanted to know before we wrap up, is there a policy from the board now in terms
Yes, so the board has made a decision to pay dividends. So that is a formal policy from the board. Our expectation is within the business that we would continue to generate strong cash flows. Within the year, we did have some one-off things that we did, particularly, one-off costs, particularly in Asia Pacific with those licenses. So quite a bit of that should reduce. Our expectation is that our cash flow will improve in FY25. So that's something that we want to continue to keep on doing, Mark, is paying those dividends to our shareholders.
Okay, perfect. Peter, thanks very much for joining us once again, and hopefully we can catch up with you later in FY25.
Thank you, Mark. Thank you, and thanks for everyone for listening.
And with that, we will hand over to the team from Quickfee, who are waiting here in the wings. Simon, Jennifer, you're very welcome. Let me just rename Simon here so he has his own official
title. I thought I'd figured out how to clone myself, and now you're taking it away from me, Mark.
That's fine. I'm not sure who's sharing the deck. Is it you, Simon, or?
Yes, I have a deck to share.
Okay. I'll let you know when I can see it coming through now. I can't see it as yet, Simon. Oh, here we go. Yeah, I can see the cover slide of your presentation now, Simon.
Okay.
So you can take it away.
Great. Well, good morning, everyone, and thank you to Mark for having us today. We're really glad that everyone could join our CFO, Simon Yeandle, and myself, Jennifer Warawa, as we share an overview of the progress we've made in the Quickfee business in both the US and Australian markets in our 2024 fiscal year. Everything that we're going to share with you today is based on a relatively simple business focus for Quickfee. We help professional service firms automate and accelerate accounts receivable while at the same time supporting them as they grow their firms. Over the next 20 minutes, we're going to share with you an update on the market dynamics in the US and an overview of Quickfee's operational and financial progress over the course of the last year. In FY25, we're focused on delivering the outcomes that the business, the board, and our investors know are possible, and we'll also recap our FY25 strategy today. So let's dive in. Now, while we're confident that we have the right strategy to support our business ambitions, the proof the strategy is working is all in the results. And in FY24, we continue to deliver strong results underpinned by great people and a laser focus on relentless execution. As you can see on this slide, in FY24, group revenue was up 37%, and our profitability improved, which was highlighted in Q4 as we were EBITDA positive. Additionally, our transaction volume set a new record in FY24, with US Pay Now TTV being 1.4 billion and group lending volume hitting 100 million Australian for the first time. We're issuing earnings guidance for the FY25 year, expecting FY25 to be EBITDA positive in the range of 1.5 to 2.5 million, weighted to the second half. And we'll get into how we plan to deliver that later on in the presentation. Overall, I'm pleased with the progress that we've made and the results that we've delivered in FY24, but I'm still very aware that this is just the tip of the iceberg and there is much more to be done and so much opportunity ahead of us. To click down another layer on the highlights that I just shared, group revenue was up 37% on PCP to 20.3 million Australian, driven by increased total transaction volumes, or TTV, and continued margin expansion. AU revenue being up 49% on PCP to 9.1 million Australian, and US revenue up 29% on PCP to 11.2 million Australian. As previously called out, we've improved our profitability, delivering group EBITDA of negative 3.2 million Australian in FY24, and we were EBITDA positive in Q4 of FY24. We have a stable cost base with operating expenses down 1% on PCP to 15.8 million Australian. And NPAT improved 3.4 million from negative 8.1 million to negative 4.7 million. Now, along with being EBITDA positive in Q4, our overall EBITDA improved significantly in H2 FY24 to negative 0.5 million, continuing the trajectory of improved profitability. Additionally, our operating expenses were 7.4 million in H2 FY24, down 1 million or 12% on H1 FY24, primarily due to a decrease in general and administrative and product development expenses. We're being extremely diligent with our spending, and that is making a noticeable impact. We've reported a very encouraging track record of revenue growth half on half for the last 3 years, as you can see here, with EBITDA showing corresponding improvements, which gives us great confidence in being able to deliver a positive FY25 EBITDA, as mentioned. Now we're going to switch over and talk specifically about the US business. There are many market dynamics that are shifting and evolving in the US. So before I get into a snapshot of the US business, I thought it would be helpful to take a step back and level set on where the US market and particularly accounting is at. On the accounting profession side, increasing inflation is putting pressure on improving cost management, also driving firms to seek more efficient, automated ways of working. The mergers and acquisition landscape in the US is extremely active, and firms are prioritizing AR reduction to improve valuation. Additionally, accounts receivable management remains a top priority as firms look to better manage their own cash flow. Through the pandemic years, many firms had more business than they could manage. These exact same firms are now experiencing slower growth and are putting sales and marketing strategies in place to attract new customers and are looking for ways to gain competitive advantages. Finally, there's a talent shortage in the accounting profession, and this continues to drive increased demand for automation capabilities across all firm functions. On the small and medium business side, uncertainty in the economy has increased, which is causing individuals and businesses to hold on to cash for as long as possible. Access to capital through traditional lending has been a challenge for SMBs, with only 25% getting their needs met. And finally, there's more competition for dollars in a business than ever before. And couple that with inflationary pressure and increasing operational costs, and businesses are looking for creative ways to make their dollars go further and also hold on to their cash as long as possible. Why is all of this market information so important to Quickfee? Well, let's take a look on the next slide. When we look across our customer base as to why they work with Quickfee, or when we win a new customer, it typically boils down to one of 4 reasons, and sometimes a combination of these. First, they want to reduce their accounts receivable, or AR. AR is typically one of the highest line items on a firm's balance sheet, and we help turn AR into cash. Second, they want to grow their business. There are many priorities competing for cash, and we can help find more of it for firms and their clients. Third, they want to automate their processes. We increase efficiency while improving the client and employee experience. And finally, they want to save on fees. Firms can save thousands and sometimes hundreds of thousands of dollars on credit card merchant fees simply by passing the credit card surcharges on to their customers. Now let's take a look at our solutions. Quickfee's payment platform allows a firm's clients to pay their invoice by ACH or card, which we refer to as Pay Now. Think of this as traditional digital payments. We also offer a lending option that's proprietary to Quickfee, Quickfee Finance. This pay over time option allows clients to pay monthly payments over 3, 6, 9, or 12 months, while the firm gets paid in full at absolutely no cost to the firm. Finally, our Connect product is a significant growth enabler in the US market. Our existing customers have a combined annual revenue of around $10 billion. Right now, only $1.4 billion of that annual revenue is processed through Quickfee. The remaining 8.6 is primarily being received by check. Now, this is where Connect comes in. Connect provides integration into leading practice management solutions, helping turn a manual, primarily paper-based invoicing process into an automated digital process by sending invoices out from the practice management solution via email. These invoices have a payment link on them, which sends customers directly to the Quickfee payment page. We now have 4 Connect integrations, being CCH Pro System FX, CCH Access, Iris Practice Engine, and Thomson Reuters Practice CS. Of course, we have some competitors that we run up against, but there are some very specific ways that we differ from our competition. Quickfee's designed specifically for professional service firms. We have no invoice maximum for Quickfee Finance. We have no hard credit checks for the clients of firms, which is important because someone doesn't want a black mark on their credit score simply because they paid an invoice on a monthly basis. We integrate with the leading practice management solutions, and we have a pricing model that works for all sizes of firms. We are the best solution that meets the needs of the largest segment of the accounting market, and we have a very competitive subscription pricing model. Now I want to pivot and recap on our strategy and share our FY24 operational progress. Now we think of this flywheel as the 5 areas that we believe will unlock transformational growth in the US market. And in fact, we're already starting to see these growth areas deliver. Our number 1 lever on our flywheel is Quickfee Finance. Quickfee Finance has revenue yields that are approximately 25 times those of our Pay Now offerings, all while delivering a solution to the market that is unmatched by any other company in the US. Secondly, Quickfee Connect is part of our growth strategy. Many firms that have adopted Connect have seen their transaction volume grow by over 40% in the same period over last year. In addition to that, by integrating Quickfee Connect with the most widely used practice management solutions in the US, firms are able to unlock automation capabilities that simply don't exist in the practice management solution itself. To maximize the transaction volume we capture from our customers, Connect is the key. In addition to Quickfee Finance and Connect, we need to deliver differentiated technology, build strong partnerships with other leaders in the industry so we can rapidly grow our reach, drive increased awareness, and acquire new customers at scale on a one-to-many basis, and leverage automation across all areas of our business. Now in FY24, we achieved a number of operational milestones that continue to build on our platform for transformational growth, which included signing 103 new customers, launching 3 new strategic partnerships with Nula, Iris Software, and Millennial Global, and developing and launching our own direct-to-bank ACH platform. I also want to call out the incredible job our product and development teams have done with building out our product functionality. Quickfee Connect has recently launched a new integration with Thomson Reuters Practice CS, while at the same time being very proactive with taking customer feedback and building that into our product roadmap. Our product suite is the best it has ever been, and with our 4 strong Connect integrations, a packed product roadmap that we're delivering on at pace, and our improved functionality in response to customer feedback, we are increasingly winning firms from competitors. And these are just a few of the achievements in FY24. Now I want to drill a little bit more into Connect. As you probably noticed in this presentation, Connect is a key focus area for us, and there's a few callouts worth noting here. First, you'll see that we've introduced a new subscription model to the market that we've started with an implementation fee of $1,995 and a monthly subscription fee of $499 a month. We'll soon be introducing additional functionality, which will be available for higher level tiers, which of course are at a higher price point. With that, Connect is incredibly important for 3 reasons. First, it has a subscription model with monthly recurring revenue streams. Second, it increases transaction volume for all of our solutions. Third, it introduces a very competitive offering that's ideal for firms that want to build their own tech stack, which is becoming increasingly important to all sizes of firms. In FY25, we have a number of new integrations on the roadmap, and in fact, we're actually already working on our next integration. Now, Quickfee has laser focus on implementing initiatives that will deliver the greatest ROI. We have a full dashboard of metrics, including a lot of early indicators that show that we're on the right track or where we need to adjust. This slide highlights just a few of these metrics that we track closely and give us confidence that our initiatives are working. You can see here that we've had positive improvements in average annual revenue per new firm sign up, the attach rate of Quickfee Finance for new firms, and the total transaction volume from new firms. That said, we did see a slight decrease in overall new firm signups, but that's directly linked to our focus on larger, higher quality firms with more opportunity for growth. For example, a potential Connect customer versus smaller firms with limited opportunity for supporting our revenue and TTV growth. These positive metrics can be directly attributed to execution plans that support our strategy, including new commission plans and a redesigned customer onboarding process, as well as improved offerings to attract higher quality firms and new strategic partnerships. In the US, we delivered strong revenue growth with US revenue up 29%, driven by 54% growth in US finance revenue to 4 million Australian and 22% growth in Pay Now revenue up to 7.2 million Australian. Our gross margin was impacted by higher interest rate expense due to rate rises and higher borrowings to fund loan book growth. However, gross profit was up 21%. The US realized improved EBITDA, now positive at 0.2 million. And finally, our new customer acquisition saw strong growth in the number of active firms, which was up 5% to 794, while the number of active customers was up 12% to 357,000. Let's take a look at how Australia did in FY24. Australia had a very strong FY24 with revenue up 49% on FY23. We saw record lending volumes and also yields, both from the fee funding and the legal disbursements funding product. For a mature market, this is a fantastic result and a testament to the hard work the team has put in over the last year. Additionally, economic conditions continue to work in our favor as interest rates remain high and inflation has not let up. The disbursement funding product delivers higher revenue per dollar originated than the traditional fee funding product as the interest compounds. And this has contributed to increased revenue yields as the disbursement funding book grows. The loan book now comprises approximately 1/3 of the Australian loan book as of the 30th of June 2024. In December 2023, Quickfee finalized the agreement with Wingate Corporate Investments for a 10 million Australian dollar funding facility to support this growth. The Australian Buy Now Pay Later product, QPay plan, which provides finance to the homeowner services market and includes the Gyms Group franchise agreement, had strong growth with FY24 TTV up 100% to 3.4 million on PCP, with FY23 at 1.7 million. This product is making small but growing positive contributions to revenue and to EBITDA. With operating expenses down 6% as non-essential costs were removed from the Australian business, the Australian region delivered EBITDA of 2.4 million Australian, with 2.2 million, up 2.2 million on FY23. I'm now going to hand it over to our CFO, Simon Yeandle, to talk through the financials.
Thank you, Jennifer. Couple of highlights here. We've talked a little bit about the P&L, but I wanted to highlight our stable cost base, particularly how it's changed over the past sort of 4.5 years. So in FY24, as well as delivering strong top-line revenue growth, we've also continued to manage costs carefully without impacting the growth potential of our products. And we're running a stable cost base of 15.8 million Australian dollars, down 0.2 million Australian dollars on FY23. Here we show the total OPEX in the chart top right, and the four main functional categories along the bottom by the last 4.5 years, and that's general and admin, selling and marketing, customer acquisition, and product development. The reduction in OpEx was primarily driven by general and admin costs reducing as we trim non-essential costs from the business, as Jennifer mentioned, and we're redeploying those dollars wherever we can into revenue-generating activities. And while product development on the far right, costs in H2 decreased from H1 quite substantially, we do expect product development costs for FY25 to remain at FY24 level over those next 12 months as we continue to invest in the Connect product particularly. In terms of funding, I'll just call out the loan book growth that we saw this year. Importantly, it's grown $12 million at a group level, 28% to 55.2 million. That's made up of 40.4 million Australian dollars in Australia and $9.9 million in the US. We also, in May and June this year, successfully financed a $4.4 million capital raise via a well-supported share placement of $3.75 million and an oversubscribed share purchase plan of almost $700,000. The capital raised will be used to fund further loan book growth in both Australia and the US to support the positive momentum in the business. And as Jennifer also mentioned, we finalised a $10 million facility with Australian lender Wingate in December 2023. And that's specifically to support our Australian disbursement funding product in Australia. And that delivered a $4 million liquidity injection when it closed in December. We've summarised the credit facilities here, both Northleaf and Wingate. We're in the process of investigating supplementary facilities to first augment and then most likely replace in full the Northleaf facility, well in advance of that maturing in November 2025. Increases in the utilisation of that facility are unavailable from October, so we'll likely run 3 facilities until sometime in in calendar year 2025. But we don't expect any material financial or operational impact from any changes in lenders we make in FY25. So to summarise, as a result of these facilities, the recent capital raise, we're comfortable we have sufficient cash reserves to fund the 12% equity contribution required for loans written as the loan book grows, and as the business is expected to be operationally cash positive in FY25. So we're well placed financially, in addition to being well positioned to grow in both markets. With that, I'll hand back to Jennifer.
Thank you, Simon. As we look ahead to FY25, we'll continue to have a focus on sustained profitability, supported by acceleration of total transaction volume and revenue from Quickfee Finance and Quickfee Connect. Our Connect integrations will continue to drive increasing demand and opportunity, allowing us to win more new customers and drive pay now and pay over time transaction volume, as well as revenue through our new subscription model. Most importantly, we expect FY25 EBITDA in the range of 1.5 to 2.5 million Australian dollars, weighted to the second half. Our outlook for FY25 is positive and is strongly supported by the momentum that we've built over the last few years. I'm now going to hand it back over to Mark for any questions.
Thanks, Jennifer. Thanks, Simon. Just a couple of questions. The first one, overall, GP margins were flat despite the revenue increasing nicely. Should we expect that again in FY25? That kind of low 60ish GP margin, or if we get another tick up in revenue, is there potential for incremental increases?
Short answer is yes. I'd probably expect GP to be somewhere between the 65 and the 70% in FY25. One of the impacts of the margin staying where it did in FY24 was we expense interest costs on our loan book borrowings as part of our cost of sales, so that impacts the GP number. So as interest rates increased, we have increased the rates we charge clients. But our cost of borrowings went up, which probably depressed the actual margin percent. We are going to see some uptick, particularly in we've managed to reduce quite a bit of costs through our ACH processing business in the US. So by moving that in-house, we've taken out a lot of third-party costs. So that will increase the margins in the sort of pay now product. And those costs will stay reasonably flat in FY25. So we'll start to see some fixed cost leverage on that business. As I say, it'll be between 65 and 70% next year.
Yeah. And Jennifer, just maybe for the benefit of people on the call and watching in the target customers, you said you were looking at slightly bigger firms. Just give us an idea of what that would look like. Is it, a firm that has 2 or 3 partners with, 10 or 15 associates? You're kind of looking at firms that have at least 20 staff or something like that. Maybe just what that kind of target customer looks like now.
Yeah, well, I mean, I would say that our target customer is, still firms that are over 1 million in revenue. So we're targeting professional services, accounting firms over 1 million, or other professional services over 2 million in revenue. But I can tell you, I mean, I talked to a firm yesterday. They're at 113 million in revenue, and they're looking at our Connect product. And then I talked to another firm today, 97 million in revenue. So we're ranging from firms that are just tipping over $1 million right up to the likes of, the BDOs and the KPMGs. So we have a wide spread of firms that we work with.
Okay. And maybe this one for Simon. On seasonality in the business, it looks like, the second half is traditionally the stronger half. Just give us a sense of, why that is. Is it more because the mature Australian business, you got financial year end that comes, June 30 in the second half?
Yes, both regions tend to have a stronger H2. In Australia, it's generally that fourth quarter, April, May, June, leading up to the end of financial year. In the US, it's tax season starts on 1 January. So January, February, March is generally a pretty slow period, but then you get a big backlog of billing that happens from sort of 15th of April onwards. So that's that last quarter of the financial year is generally pretty strong. Plus, there's continued sort of growth, organic growth year on year and quarter on quarter, pretty much throughout the business. So given that's happening half on half, you tend to see, an underlying growth rate as well.
And Jennifer, I might throw this next one back to you. If somebody takes on, the Quickfee suite of solutions, let's say, what in terms of accounts receivable days improvements do clients tend to see? Are they moving from 60 days down to 45 days? Just give us a sense of, what the lived experience is for clients, that you've seen once, they've been in the Quickfee system for, let's say, a year.
Yeah, we especially with Quickfee Connect, we recently launched automated reminders, and they can start as early as 7 days after an invoice. So we've had firms that have had receivables extending out. It's not unusual for us to have firms that have receivables over 100 days. We regularly, when we start working with someone, they're like, "Oh, you only do reminders to 130 days. What about for customers that owe us money after that?" It's like, you have customers that are over 130 days. They're like, "Yeah, you don't even want to know." So, but we had a firm that they were running typically over 90 days. When we send out the reminders, they said that they have a large portion of their clients that are paying within 7 days. So they're like, they didn't even think they'd pay with the reminder because they have 30-day terms. But they're like, they just get the reminder and they pay. And they're like, geez, I wish I would have thought of that earlier. And they're not doing anything. It's automated. So the firms have been very happy. We actually had a firm that we did a webcast with a couple of weeks ago, said they've seen a 90% reduction in their accounts receivable. So that is significant. And we love to hear stories like that.
Okay. And then just on the CapEx side in terms of product development, I know, Simon, you said in your presentation there, it's kind of going to be in and around that 2 million mark again for next year. In terms of, your thinking for CapEx, is it you're kind of set on that budget for now of kind of 2 million a year, or do you think of it, it's kind of a percentage of revenue? Just maybe how are you thinking about CapEx given, all of the improvements and, new bells and whistles that have come on as Jennifer talked at the start there?
Yeah, it's I'll just that 2 million is half year. It's going to be more like 4 million year on year,
Okay.
Australian dollars for the full year. at the moment, while we're still building product, and we're still integrating with new practice management systems to really accelerate that sort of capture of the market as much as possible. It'll continue at that level for FY25. Beyond that, it could well diminish as we see a lot of the new build sort of recede, and it becomes more a maintenance and enhancement sort of model. And we are currently expensing 100% of that. We did in FY24. In FY25, the accounting standards may require us to capitalize a very small portion of that. But generally speaking, that expense line will stay pretty much the same in FY24.
Okay. And final one maybe for you, Jennifer, in terms of, you've had kind of plus minus 100 customers, every year. How long does it take to actually onboard one and, obviously for them start seeing the benefits, but more importantly for you to, start seeing the revenue flowing into Quickfee? Is it, a month-long integration? Is it a kind of a 3-month process?
Sure. So if we're getting a new customer, let's say they sign up for our core products of ACH, card, and finance, we can have ACH up and running typically within 48 hours. Finance we can have up and running in that same time frame, and card takes up to a week. So within 1 week, they have all of our products live and they're able to accept payments. When you look at Connect, we typically look at it in the realm of, it's 4 30-minute meetings with the firm. Those 4 meetings can be a month apart, a week apart, or 2 days apart. We've done them in as fast as 10 days for an implementation, but there's some work to do on their side with cleaning up the customer contacts, making sure they have email addresses. So we can move as fast as a firm wants to move, but I'd say, 2 weeks is great for the implementation, but it could be longer if the firm has more work to do on their side.
Okay, perfect. Jennifer, thank you very much for joining us again, and indeed Simon, and we look forward to hearing from you hopefully later in FY25.
Great. Thank you so much, Mark. Thanks for having us.
Thank you, Mark.
No problem. And we will move on to our third presenter of the morning. Paul McDonald is back joining us. Paul, good morning. How are you?
Good morning, Mark. How you doing? It's good to be
Very
here.
well. Yeah, good to be back. Paul joined us at our Sydney conference recently, live and in person. And he went down so well there, we said we'd get him back on here in the online version. I see Brendan is here with us as well. I'm not sure who's sharing the presentation. Are you sharing it directly, Paul, or is Brendan driving slides for you?
I'll share, Mark.
Hi, Mark.
Yeah.
Good to see you.
Brendan, good to see you again.
Just
Okay,
check you can see that okay.
I can indeed, Paul. I was just about to say you can take it away. I can see the cover slide, the deck now.
Great. Thanks, Mark. So I'll go through probably some of the more key slides about our 24-year full results. There's quite a number of pages on this slideshow, so given time, I'll try to focus on the main ones. There's just a disclaimer here to discuss the potential forward-looking statements, etc., protect the company and the viewers. Look, we are a 50-year-old pharmaceutical contract manufacturing organisation at IDT, and we are seeing some substantial growth come through the plan. We are focused on 3 specific pillars in manufacturing active pharmaceutical ingredient for drugs, fill finish in sterile injectable, and then tablets and capsules. So the API is actually a vertically integrated process to move into those programs. So as we're focusing on the strategy of growing all 3 of those strategic pillars, we aren't just focused on sort of the Me Too class of drugs, the standard high volume, low margin products. We're actually looking at quite complex programs, difficult to make, high barriers of entry, and we're also looking at what we see as global megatrends in the pharmaceutical business. That being mostly mRNA. mRNA is not a new pharmaceutical format. It's something that's been around for many years. It's first discovered in the early 60s, 70s, but producing a pharmaceutical product really hit its straps during the COVID pandemic. So RNA technologies have multiple opportunities for pharmaceutical product, and we see it as a substantial global megatrend. The antibody drug conjugate is also a very interesting one. Similar to RNA, it's been around at least for a therapeutic for quite some time. It's actually been seen as what we call as the silver bullet for cancer, where it's a highly potent targeting medicine that will attach to a tumor and significantly damage a tumor to the point of cell death, and it won't be so effective or won't have an affinity to healthy cells. So we're really looking at a smart chemo, a targeting chemo, and IDT is really pushing forward with a strategy to manufacture fee for service, or even potentially at some point some of our own products in the ADC category. Strong asset backing for the company. We recently did a replacement value for our insurance purposes, and the facility, the buildings and the equipment and facilities were valued at 88.8 million, with a land and building of 17.2 million. So that's obviously far outstrips our current market cap, and also we have a cash balance on the balance sheet. Now, the difference between FY23 and 24, you can see potentially a doubling of revenue, a practical doubling of revenue in 12 months, based on the strategies that we've put together. You can see here the active pharmaceutical ingredient, the API. So this is a chemistry process. It's generally a number of weeks process where we would synthesize a molecule, or we would start with the starting material and we'd add the building blocks onto that molecule to turn it into that active ingredient. So there's a very legitimate science behind API synthesis, and we have several PhD synthetic chemists that design the synthetic route and then manufacture on behalf of our customers. So this is normally an area that's been dominated by sort of India and China. And we've seen that if we're focusing on novel APIs, new molecules, new medicines, new targets, that we're getting quite a lot of success for companies, both in Australia and internationally, wanting to do business with IDT. We have a really strong grounds for IP protection, and we also got a fast path into phase 1 clinical trials. And then we'll take that API and then we'll put it into an oral. So you can see here our oral branch, how it's been quite stable, but the API is growing. So a lot of those APIs will then get converted to oral, and then we'll see a little bit of a bump in the oral coming through in the next 6 months. Now, what we're really excited about is this advanced therapies line. You can see here in 23, it was quite immaterial, and you can see now we're starting to grow in materiality. We also signed a substantial contract with Sanofi, and we've announced that it's in the public domain, to a value of somewhere around about 4 to 6.5, 6.9 million. So that program didn't start until April 19, 2024. So you're going to see a lot of that benefit coming through, through the next 6 months or through the 9 months of FY25. So we're going to see this advanced therapy line growing. Well, you see it's gone 4 or 5-fold here, 415% increase, but you've also going to see further increase coming through to 25. That sterile filling line was set up and put together through the pandemic to do a pandemic response. And we secured a government contract to do that. So now we're making use of that program that we did back there in 2022 and 21, and making use of that in complex pharmaceuticals. You can see that our losses, I'm open about the losses. The company has been in a loss-making period, but we're approaching a profit point through 25, and you can see that we have decreased the losses, and we expect to go cash flow positive during FY25. Quarter on quarter growth, you can see really, this is when we did a strategic reset in 23, and you can see quite a substantial improvement going on quarter by quarter. You can see here the specialty orals and the API bands both growing. You can see lumpy workflows because, as I said, we might manufacture an API, and then that API will then go across into and be formulated into an oral. It can also be formulated into a sterile injectable advanced therapy, but most of our programs are going API into oral. So you can see those two bands growing together as we move along. And as we continue to win more business through our pipeline, the lumpiness of those revenue flows will start to smooth out. I will also point out back here in Q1 23, the plant was running at about a 5 to 10% capacity utilization. And back here through Q4 24, we've peaked somewhere around about the 30 to 35% capacity. So even though we've had a substantial uplift over these 8 quarters, we've got a lot more capacity and room to grow further. These are the 3 strategic pillars. I did make reference to them in opening. The active pharmaceutical ingredient. What is our core driver for this is that we're manufacturing novel APIs. Our team is synthesizing new molecules, new medical targets, and doing first time in our facility that's fit for human. That aligns with the phase 1 trials in Australia and in further clinical trials as well, and also with IP-friendly nation. Most of those APIs are either converted into specialty oral, and a small percentage of them might be shipped overseas for further processing, but most of them are converted in our specialty oral. So the two pillars work really well together. The advanced therapy is our more recent addition. This is more of our sandpit pillar, where we're seeing those global mega trends in RNA and ADC and trying to grow that one from a baseline of effectively 0, which we're seeing very fast growth already. Specialty orals really does focus a lot toward mental health and neurological disorders. We've got products running through our plant for epilepsy, for Alzheimer's, for traumatic brain injury, for oxidative stress. So a lot of CNS type disorders we're putting into these tablets. The API performance, as shown earlier within the bands of the rolled up, you can see that over from 23 to 24, we've had a substantial jump in API. And that's really just focusing on really drilling down on these novel APIs. We have also had quite a reasonable percentage of return work in our API. When you're manufacturing clinical trials, you may do an API and then the customer might not come back for 3 years or 2 years. But some of our API customers are reaching a mature state. They're getting very close to their commercial launches and the volumes are increasing. So we have 3 clients in that space right now, which we're really proud to have been on that journey with them. So while we're adding new business to the API pillar, we're also getting an increase in return work and larger volumes from our trusted clients. The addressable market, this is really based on what we think that we could do as a ceiling if we utilized full capacity. There is a mix. Not all APIs have the same margin or the same value. It's just based on the indication that they're chasing. It creates a different value proposition. But if we feel that there is a substantial API market, it is dominated in China and India. And if we carve out the particular API customers that we think we can bring to Australia, we can deliver about an 18 million with all the capacity consumed. The specialty orals, while we didn't see so much of an increase, we actually had a little bit of a headwind from the cannabis market. It was building up quite nicely, and then there was a flooding in the market pre-July 1, 2023. That's when the TGA heightened the standards for medicinal cannabis. So through that process, the market was flooded, the unit price came down, and it was quite difficult to navigate our first half of last year. However, the second half, we saw signs of returning to the cannabis market. The volumes picked up again. It's not quite what it was pre-July 23, but it's approaching those levels now. So while we had a headwind in medicinal cannabis, we actually managed to capture some of the other tablet and capsule orals that come through in the mental health space. The capacity of the orals, again, dependent on mix. Some products have a greater value proposition. We believe at full capacity, we could deliver a potential ceiling of 72 million from the oral business. You could also add more additional capacity to the facility and streamline current processes to generate more efficiency as the capacity is reached. So we see that a potential ceiling of 72 million could be achieved with a full market capture. Now, this is the one that we're really excited about. Again, we really started from a baseline of zero in 2021 and 2 as we were recommissioning and qualifying and getting a regulatory license for our sterile filling line. We've deliberately chosen to focus on complex formulations and very hard to manufacture pharmaceuticals. So the mRNA is a biological transcript that comes from the cells, and then we encapsulate that into a very small nanoparticle, which is literally a droplet of fat. And so that protects the mRNA from being degraded through the body until it reaches its target and creates its cellular changes. So the mRNA is a very complex process. There's also other forms of RNA and siRNA, etc., that is a sort of antidote to mRNA. So there's other pharmaceutical targets that we're developing at IDT, and we're very happy with a recent securing contract with Sanofi to work on their RNA programs and pipeline. The antibody drug conjugate, as I explained before, is a smart chemotherapy. We received a grant from the Victorian government to stimulate our expansion in the ADC. Currently, we have very small scale capability, and once we've completed a pilot facility, we will be able to scale up, and then that will take us all the way through to phase 1, phase 2 clinical trials. We've got quite a lot of early leads and partnerships that we're forming in this space. So, we're quite excited of that market. It's about a $14 billion market today, and they expect that to take over traditional modes of chemotherapy and push its way toward a $140 billion market in the next 10 years. So if we can establish some sort of small market share in that space, contract manufacturing capacity for antibody drug conjugates is a premium across the globe. So we're in there, we've got our foot in the door, and we think that we can really generate shareholder value from that strategy. As I explained, the Victorian government is supporting us with a grant to progress the commercial ADC facility, the pilot scale at first, then leading on toward commercial. Now, you see here, there's a huge sum on the antibody drug conjugate and mRNA. mRNA was a $50 billion program during COVID, and The antibody drug conjugate is a $14 billion program today, growing to potentially tenfold as it consumes traditional modes of chemotherapy. Now, some of these ADCs are selling for anywhere from $10,000 to $15,000 a dose. So if we were able to capture just the tiniest market share in antibody drug conjugate, $15,000 a dose or $10,000 a dose, multiplied by, say, 500,000 units, and then the contract manufacturer typically takes about a 5 to 10% fee on the retail price. So that's how we've calculated 805 million. Even if we were just able to manufacture, say, 500,000 to 1 million units of antibody drug conjugates, that's a potential that we could reach. So we obviously are pushing really hard. That's a long way off for us to get to that point. Last year we did just over 1.2 million, but we expect to grow that 1.2 million very quickly. And that's a sort of ceiling that we expect that we could reach if we established a market share. Very positive outlook on FY25. We've got a substantial sales pipeline pushing through and getting converted every week. We have the last count was a $25 million pipeline that we are actively progressing. We have added to that since. The growing megatrends for mRNA and ADC and mental health disorders and general CNS disorders it's a growing field. So we're in that space, and we don't see that slowing down in the unmet medical needs at any time soon. We're approaching a profitability point. We've slowed down losses, and we're expecting increase through loss into profit during FY25. We're generating a lot more repeat business workflows coming through. Our clients we're seeing them right through the journey, right to core commercialization. And we've also picked up a couple of recent clients that are transferring their technology in directly to do commercial manufacturing. So those dossiers will go out to the TGA and the FDA, and that will give us a steady workflow. And again, it'll start smoothing out some of those lumpy revenues. A regional leadership. There's very few companies doing API manufacture right through to finished product in our region. And in fact, in Australia, we're pretty much it as far as small molecule goes. We're really the only ones doing it. And we recently completed a $7 million rights issue to hold a bank balance. And then there's some acronyms also in play. But I'll pause there, Mark, for questions.
Yeah, questions have been flying in while you've been working through the deck there, Paul.
Very good.
So we'll get straight on to them. One quick one was you didn't really touch on it in the slides, but what is the disbursement revenue line? Just a question.
The disbursement revenue line is when we're purchasing and purchasing goods and equipment as a general handling fee that goes with those. So we have a very small markup on purchasing material and equipment on our clients. So that's where the disbursements come in.
Okay. Then on the Sanofi partnership, a question on how their clinical program is progressing and visibility on further orders through the next 12 months. So I'm not sure where they're up to.
Yeah, that's a difficult one to answer, Mark. We are under confidentiality, and Sanofi is a top 10 pharmaceutical company, so they're really looking to generate blockbusters out of the work that we're doing. So they have an mRNA pipeline. They have extensive research from their own laboratories, and they are outsourcing the phase one manufacturing to IDT. So there is effectively an mRNA manufacturing platform, and they will continue to run assets through that platform once it's completely set up. So we have a 5-year master service agreement with Sanofi, so we expect that relationship to remain strong and continue for many financial years.
And then I had one email through. Let me just get it up here. I don't want to forget about it in all these ones that came in. It's on the API business. Just a question on, are governments requiring countries, or are they looking basically to get in-country manufacturing done now, kind of post-pandemic, where, logistics, supply chains, all of that kind of stuff kind of came into sharp focus. And we've seen a lot of other industries where governments are saying, no, we need to have our own industry here and not be taking stuff from China or India or another part of the globe where, 90% of the world's manufacturing for this particular thing happens. Is that something that's happening within Australia, and kind of your customers on the lead end, they want a local manufacturer now as a backup, or as a primary source, with maybe China now working as a backup?
Yeah, that's a great question. Yes, the answer is yes, 100%. So you will see that the government spent a lot of money establishing mRNA manufacturing in Melbourne with Moderna and BioNTech, and then also they've also across the eastern seaboard in Sydney and Queensland, there's other Southern RNA and other companies starting up. So the government sees a strategic advantage of mRNA. With the more routine, regular type pharmaceuticals, your typical prescription meds, they're still lacking there, right? So 90% of the medicines that hit Australia's shore are imported. And in fact, I think the number's about 95% of the pharmaceuticals manufactured in Australia are exported. So you can see that it's kind of all the wrong way around. We are talking very close with government about sovereign manufacturing opportunities. While our strategy is very much focused on unmet medical needs and sort of producing a product, taking research and moving it from bench to patient, we also have a play to role in sovereign manufacturing. So we are engaging with government to explore if we can make the API that goes into a large volume product to address drug shortages, or the reliance on importing pharmaceutical medicines. So we are having those conversations. I feel that the system's a little bit stuck, and it probably needs a lot of work before we can really get some traction.
I'm going to read this one kind of word for word, because it's a bit technical, but hopefully, Paul, you'll be fine to tackle it. Related to the specialty oral line, the FDA recently rejected MDMA treatment application from Lycos. How is Australia TGA approved MDA treatment market developing? Has IDT formed contract relationships with key Australian players for potential future material sales?
Short answer is yes. We've absolutely generated strategic partnerships in Australia and some level of global networking as well. So yes, we have manufactured quite a large batch of MDMA. Also some of the other psychedelics that we see of interest for post-traumatic stress disorder. Yes, I think with the FDA, I have read the report and the guidance, and it seems that the FDA have established that the dosing of MDMA is not significant with respect to current modes of treatment. So in Australia, they've set up trials with products like psilocybin and MDMA for patients that have failed to respond to the routine treatments for post-traumatic stress disorder. So then they go on to this special access scheme, authorized prescription Now, they're seeing really good results. So it's quite contrary to what we're seeing in the USA, where they haven't found a significant benefit from MDMA. So I suspect that's got a bit further to play out in the future.
Okay. A question on, I know you had a takeover approach earlier in the year. Maybe just touch on that. Is there talk still ongoing? Is it kind of been put to bed now? And the other question is, kind of the rationale for, the approach that you got. What was kind of their angle for, wanting to, bring IDT into their kind of stable?
Yeah, it's a good question again. The MindBio is a company that is in the psychedelic space. Plus, they have other manufacturing that they are adopting, and they're a customer of IDT. So an acquisition looks like a good fit. They put on a non-binding offer back in June, July, and the board had agreed to a due diligence process. While the board didn't endorse the 15-cent offer, they allowed a due diligence process to take place. So there's no further updates than the ASX announcement we put out at the time. When there is an update, the company will put out another ASX announcement.
Okay. Paul, I think we will leave it there. We're just bang on time. So thank you very much for coming back and joining us. And we'll hopefully have you back in later in the year.
Thanks, Mark, and thank everybody for watching. Great questions coming through too. Thank you very much.
No problem. Paul, if I could please ask you to stop sharing your screen, and we will hand over to our final presenter of the morning. We've got James Beeson here from Earlypay. James, good morning.
Hello, Mark. How are you?
I'm very well, thank you. Yeah, your audio sounds good now.
Good. Let me get this screen up.
Yeah, I'll confirm now once I can see it. I'd like to welcome James. He's a first-time presenter here with us. Always good to hear a new story. So I'm looking forward to this one myself. It's coming through now, James. Yeah, I can see your desktop now. Yeah, I can see the cover side of the deck.
Okay, great. Thank you. Well, thanks for having me today, Mark, and
No
appreciate the opportunity to speak to you.
You can take it away.
Okay. So given many of you might not be aware of Earlypay, I thought I'd start with a quick overview of the business. So in 2012, we started to provide invoice financing to payroll services businesses, because that's a natural industry that has a cash flow gap where the labour hire businesses and recruiters have to pay their contractors every week or so, but they don't get the money from their customers for a month or 6 weeks. So that's how Earlypay started, in invoice financing initially, and invoice financing remains our core product. It's what we where we want to grow the most, and it's our biggest part of our portfolio so far. Although it's also supported by equipment finance and trade finance. Equipment finance, we lend money against trucks and trailers and yellow goods and things like that. And trade finance is where we pay suppliers, and that's quite closely linked to our invoice finance product. But the emphasis on trade finance has diminished somewhat, and we're really focusing on invoice and equipment finance. And invoice finance, it's increasingly popular because accounts receivable are a large portion of the balance sheet on businesses' balance sheets. And it's not really tapped for financing, and more often than not, the banks require real estate property to advance funding. So it's a good way to unlock value from that part of the balance sheet. And we estimate around 35% of SMEs in Australia operate business to business, and that's a key part of invoice financing for us, because it's about invoicing, raising invoices to other businesses that we fund. We have around 3,000 clients across our equipment finance book and our invoice finance book. And at the end of financial year 24, our loan portfolio was around $250 million. And we lend to a range of industries. On the invoice finance side, manufacturing, labour hire, wholesale trade, and also some infrastructure. They're the biggest industries there. And on the equipment finance, it's probably broader. We do lending to transport businesses and civil construction, and also a little bit to construction as well. At the moment, our share price could be a tick higher than that at the moment, but our market cap is around $50 million. At the end of June, our cash and cash equivalents was around $40 million, and our underlying pro forma NPAT was $4.9 million that I'll expand on in a bit, which puts us on about a 10 times multiple. And our NTA, in terms of cents per share, was just shy of 15 cents. So on to the results. So underlying pro forma NPAT, which adjusts for non-recurring items and amortization, and also the impact of a large loss we had in financial year 23 relating to a business called RevRoof. Adjusting for those factors, the underlying pro forma NPAT was $4.9 million in 24, which was up from $4.1 million in financial year 23. That was slightly restated due to an issue we had in equipment finance, but that won't happen again. We've addressed that issue. The underlying pro forma earnings per share was 1.7 cents per share, and the board declared a dividend of just 0.15 cents per share, which is quite low and a lot lower than the earnings per share. But because we have limited amount of retained profits to pay dividends from, that was what constrained that. As retained profits are rebuilt through time, it's the board's expectation that the dividend payout ratio will revert back to historical levels, which is about 50 or 60% of earnings. After a challenging financial year 23, there was a lot of focus this year on strengthening the foundations of the business. So the foundations are a lot stronger for future growth, and several key milestones were completed. The debt refinancing was a big one. We restructured our invoice and trade finance arrangement to have a new warehouse facility, and we inserted some MES into that, which makes it a lot or significantly cheaper. We'll save about 1% on our cost of funding there. It's also a lot easier to manage having one warehouse instead of there were three before. And inserting the MES, it makes it a lot more capital efficient. For every invoice finance receivable that we fund, our equity contribution is around 5 cents in the dollar. So we don't need a whole lot of capital to grow. With equipment finance, we exited a small equipment finance facility and rolled those assets into the main warehouse. We also had some constraints relating to asset class parameters that restricted our origination in financial year 24, but they've been modified now, so we're back to originating strongly. There was a corporate bond that was fully repaid. That was $20 million. And to do that, we added a new $10 million corporate facility that we only expect to have for 9 or 12 months, and we'll pay that out. At the end of last calendar year, we acquired a business called Timelio, which focused on invoice financing, a little bit of trade. So that integration has now pretty much fully completed. The receivables portfolio that came with Timelio was quite high quality. A lot of it came from Bendigo Bank that they themselves acquired from Timelio acquired it from Bendigo Bank a couple of years ago. So close enough to bank quality credits for the most part there, although that comes at slightly tighter margins. The Timelio integration, as well as the receivables portfolio, we brought across about a dozen people, and that was really supportive of our tech capability. And I'll talk about the benefits of that later. It's really helping us operationally, but also on the growth side. RevRoof, that was a painful time in financial year 23, but as of the end of financial year 24, that's all resolved and there's no outstanding exposure. There are a lot of other important improvements to underwriting and credit risk processes, pretty much from lessons that we learned from the RevRoof issue. And now we're in good shape in terms of having a much more balanced risk appetite, and that's supportive of growing strongly again. Part of the learnings from that was that we have been shifting the mix of client receivables to be less concentrated to single borrowers and reducing our exposure to trade finance, and also to selected invoice finance exposures that we weren't comfortable with the risk. With these milestones complete, we now have a lot more confidence to get back and grow the invoice financing book. Trade finance is less of a focus, as I said, but also equipment finance. We want to get that growing fairly strongly again as well. To this end, we've added some capability in sales and marketing, and also we are focusing on a different distribution channel through embedded finance that I'll touch on a little bit later. And I think that's going to have a meaningful contribution to funds in use growth in the future. Looking forward to 25, although we're starting at a lower base in terms of funds in use, the business has had a lot of momentum into the last couple of months of 24 and so far in 25. So we're really optimistic that the 25 are going to bounce back even further in profitability and funds in use, supported by wider margins. The total funds in use fell by 14%. That's the average funds in use for the year. This reflects a number of factors, including rebalancing the portfolio to be more in line with the board's risk appetite, larger than normal client attrition due to economic stress, and also the asset class parameter in equipment finance that I mentioned before really affected the amount of originations that we could do. And the nature of the equipment finance book is that it pays down every month, it runs off. So we were originating less than the runoff amount. So the book went backwards in terms of funds in use. With the funds in use, particularly on trade finance and invoice finance, a lot of the loss in funds of use was with larger, tighter margin clients. So the net revenue impact was less than the loss in the funds in use. And as we grow again, we're finding that we're lending smaller amounts at higher margins. So we don't need the full funds in use to be replaced to replace the net revenue. At the end of financial year 24, as I said before, momentum was strong and it was kind of hidden a bit. We had one large client leave us. They just didn't have the need for debt funding anymore. And that was around $9 million. So that really masked the momentum that we had towards the end of the financial year. There were some one-offs affecting OPEX in 23 as well as 24, but generally the cost base has been adjusted lower to be more efficient and to offset the fall in net revenue, which will enhance operating leverage as net revenue rebounds. Underlying credit impairments fell significantly, and we're hopeful that the adjustments we've made on our risk settings will continue to have that moving lower. There's also some amortization of customer relationships, which when we bought Timelio at the end of last calendar year, that was capitalized, and that's going to amortize over the next 2.5 years. Onto the invoice and trade segment. A lot of the clients that left in 24 were low margin, and they're being replaced by higher margin clients. Also, with the debt refinancing, we're really starting to get the benefit of wider NIMs. If you look here, the net interest margin for the whole year was 5.5% for this segment. There was a one-off that affected that to make it 5.5, and if you normalize that back, it's actually 5.9%. And then the refinancing only came into effect at the end of the financial year. So when we get the full 12 months benefit of that, we expect the NIM on this segment to be heading back towards 6.5%. So with funds in use growth and also wider margins, it's going to support net revenue in 25. I mentioned before the Timelio acquisition and the quality of that book, that weighed a little bit on margins because it's higher quality and lower margins. But as we get back to originating Earlypay type credits and margins, then that will be diluted. Also, the Timely clients, many of them, because they're better quality, they don't require other services of ours, like collections services and even bad debt protection, which is where we make margins from our other traditional clients. With OPEX, once you adjust for amortization and the non-recurring expenses, it was slightly lower, and we restructured the business in Q4 after the Timely integration was more complete. So the cost base for at the end of 24 ended lower than what it was averaging throughout the whole of 24. So we're in a good starting point baseline for 25. And as mentioned before, the credit impairments were significantly lower, which is encouraging. And I think that's a reflection of the improvements we've made in our risk management. Equipment finance. Again, the portfolio constraints that we had really curtailed new originations, and the book went backwards, but that has turned around in the last couple of months of 24 and so far in 25. So we expect that book to grow back. Credit impairment expense was a bit higher in 24, but the 30+ day arrears remains fairly modest, around 90 basis points, and that's a good forward-looking indicator of future impairments. The restatement that I mentioned before that related to a legacy loan management system. There was an error that overstated the income in 23 by $538,000. So that we had to restate 23 income because of that, but that's absolutely been fixed and won't happen again. And one of the issues with that restatement is that it reduced our retained profits balance, which limited even more the amount of dividend that we could pay out. So again, hopefully going forward, the dividend will be significantly higher than it has been in this period. The client receivables portfolio, this is across all products. There's been a big push over the past 18 months to reduce concentrated single borrower exposures and have a much more diversified pool of client receivables. And although this is still a work in progress, we've definitely made some inroads on that. And our largest single borrower exposure at the moment is less than 10. And that is down a long way from the peak of a couple of years ago. We've also made the conscious decision to reduce exposure to trade finance, as that's inherently a riskier product. And it's also contributed to many of the headaches that we had over the past 18 months, and really get back to growing invoice finance, which we think we could be great at that. And also equipment finance. Geographically, and by industry, I think it's a pretty good spread of where our clients play. So with distribution, traditional channels, that's commercial finance brokers, that continues to be the main source of referrals for Earlypay. And we continue to invest in educational programs to increase the awareness of invoice financing and also Earlypay, as well as improving automation to provide a better referrer experience. A lot of the commercial finance brokers in Australia, they focus on asset finance. So a big part of the trick is just to increase the awareness of our product. And we're seeing the benefits of that. Also, given the economic backdrop, insolvency practitioners and business advisors are also a growing source of referrals. And we're doing a better job of marketing to those guys as well, which is contributing more than it has in the past of our new originations. Now, a new channel that's very exciting is embedded finance. And this is where we work with third-party platforms and partners to offer invoice finance, early payments of invoices in their platforms. A great example of this is our partnership with Earlytrade. They're Australia's leading provider of supplier early payments, and we've partnered with them as their exclusive invoice finance partner in Australia. And they have literally tens of thousands of suppliers on their platform. And this partnership allows us to fund the invoices of the users of their platform that can't be funded by the Earlytrade platform. So that's a huge opportunity, and already we're seeing that's going to be great for us. Another partnership that is recent is with Zemplo. So Zemplo is a recruitment and labour hire platform. It helps those businesses manage their payroll. And a nice thing for that is that we can integrate with this platform and offer financing to labour hire and recruitment businesses in the Zemplo platform. And also we can use our API to pull and push information from our system to Zemplo's, which makes it a lot easier for getting the supporting documentation like the timesheets to support the invoices that we're funding, which makes it better for us from a risk perspective. It makes it easier for us to get funding to their clients sooner. And also operationally, it's much better for us and the clients because we're not hassling them for timesheets. We just ingest it automatically. So they're just two live examples of the embedded finance opportunity, but we're working on several others that we'll be able to talk about very soon. And we think that we're really well placed to be a leader in this space with the tech capability that's supported by the Timely acquisition, as well as the scale that we have, the relative scale that we have, and efficient funding warehouse, and just our DNA of invoice financing over a very long time. None of our competitors really have that combination. So I think we're well placed to do really well there. And because of that, I think it's going to be a key part of our growth in the future. You can see at the top there, so far, this doesn't contribute really at all to our new distribution, but it's starting to in 25, and that 0%. I'm not sure what we expect it to get up to exactly because it's a big question mark, but definitely we see it as a key place where we're investing. So onto the outlook. Much of the last 18 months has been focused on strengthening the foundations of the business, and our focus has now returned to growing funds in use, expanding margins, and achieving strong profitability. The economic and competitive environment is very supportive of our business, and we have invested more in sales and marketing to maximize this opportunity. Many SMEs engage trusted brokers to source new finance, and it remains a critical distribution channel for us. But we also want to expand more into the non-traditional channels, such as the embedded finance opportunities that I mentioned before. And again, we think that we're well placed to really dominate there. And we're really playing to our strengths by expanding into that area, given our core capabilities. The resumption of growth, it's supported by a much more balanced and systematic approach to underwriting. Improvements have been made with onboarding, settlement, and documentation processes to help get funds to clients sooner. And we're also engaging a lot more with clients than in the past to understand their needs and how we can better serve them. And that's coming through with our retention of clients and also referrals from clients. And to augment our organic growth, we're always on the lookout for inorganic opportunities to help us get scale in our core invoice financing product. And any acquisitions would really be focused on invoice finance, not the other lending products. So new business momentum is strong, and coupled with the margin expansion that we expect in 25, tight cost control and strong risk management, we expect to have a strong 2025. And we'll provide an update at the AGM.
Okay, perfect. Thanks, James. Got a question in here on the new distribution channels. How much customized integration work is required for each of the embedded payment partners? What's the CapEx timeframe for these integrations? So maybe just talk through the work involved to onboard with the two that you have.
So we have built our own API over the last few months, and that's built to be quite transferable. So there's a lot that's similar with all of these opportunities. Once we get early trade and Zemplo done, then a lot of it's just copy and paste really, and we can take the same principles and roll it out pretty easy to the others. And I expect that before Christmas, there's probably another 2 or 3 that we can talk about.
Okay, that leads me on to kind of a follow-on question I had to that was the equipment finance. Is there, a possibility of, doing something on because the two you have, if I'm not mistaken, are more on the invoicing side, whereas on the equipment finance side, is there partners you can line up with there? We've had Robbie from High Pages on here. He's got a huge network of tradies. Is there, something that could be done there, or, similar style platforms where you've got people who are looking for equipment finance or have very equipment heavy businesses?
It's not at the top of our list. We feel like the massive opportunity is really in invoice financing, and we want to see that through properly and make the most of that. That invoice financing really is our DNA. And equipment finance is very much a secondary product that supports our distribution of invoice finance as well as being a profitable segment itself. But invoice finance is the main game for us, and that's where we're investing our resources for now.
And just on the invoice financing market, I mean, where would you guys say you are in terms of like market share? And then a second question then is invoice financing and equipment financing, kind of like a lot of other credit lines where the major banks, because of like kind of Basel III over the last 10 years, we've seen, have really pulled back from, I would don't want to say esoteric credit lines, but, a lot of these credit lines, they've kind of moved away from and just purely focused on, your personal car, home loans, and a lot of these other services to businesses, they've actually said, and to consumers on the short-term lending personal loan side, they've said it's not actually worth our while given the Basel III restrictions.
Yeah, certainly the banks have stepped back from business lending generally across all products, and we've been a beneficiary of that. The one or two of the banks are talking about expanding into invoice financing, and we see that as a great positive to help with the awareness, because the uptake of invoice financing in Australia is really quite low compared to other countries, certainly compared to Europe. So anyone that talks about it, it's a great thing, and the banks will always have clients that they're not happy with, and that would meet our risk appetite. So we welcome that. And in terms of our market share, I think we are probably one of the bigger players in invoice financing. There's a competitor that's bigger than us, significantly bigger than us, but we're really hoping to aggressively catch up to them. And I think that a key part of that is our technology focus, because many of our competitors don't have that capability and they can't take advantage of this embedded finance opportunity that I mentioned before.
Got another question in here. Hold on, we've got two in here now. Okay, let me tackle the first one here. Do you expect growth in the invoice financing book to come from client growth or increased usage from existing clients, or maybe with a slower pay down rate?
It's a good question. It will be a mix. So certainly new clients to us, that will drive a lot of the growth, but also funds in use to existing clients. It has risen during 18 months ago, where we had some credit issues. We really tightened the screws on a lot of our clients and were a bit conservative with the amount of collateral that was available to advance funds against. I think that we have a much more balanced risk setting on that, and we've increased the approved receivables that can be drawn down against for high quality clients, but also being vigilant with the higher risk clients. So it's really a mix. I think our retention is going to be stronger because we're servicing our clients a lot better than we probably have in the past. So attrition will be lower. Client referrals is actually significantly higher than it's ever been. We're getting a lot of referrals from staff as well. Staff are a lot more engaged and promoting getting new clients. So, and then the broker channel, as I said before, it continues to be fundamental to our distribution, and these other channels through insolvency practitioners. And then the kicker will be what comes through the embedded finance channel, which it's coming from essentially zero, and it's super exciting. So combination of those things holds us in really good stead for 25, and it's not hope, like we're seeing it already in the first couple of months of 25.
And then I doubt to be appetite for this, but have you ever considered doing a distribution deal with a major bank to be the provider of invoice financing to their clients? It sounds like the banks are starting to go the other way. They want to do it themselves.
Yeah, possibly. Our view is that we want to. There's a huge opportunity for us to monetize if we just use it ourselves, do it ourselves, and we want to maximize that first. And when we approach that point, then we might consider that. But for now, we just want to get back to growth and do invoice financing better than anyone else. And I think good things will come from that.
We got another one here, James, if we can squeeze it in. on the clients referred to by the insolvency practitioners. They're saying, wouldn't these already be financially distressed and inherently more risky to extend finance to? So maybe just talk about the type of clients you get from that particular channel, and I guess how you manage the risk in it.
Yeah. So within invoice finance, there's quite a broad spectrum of types of invoice finance. There's confidential invoice discounting, where we lend money to good quality clients, and it's more of a light touch approach with monitoring their accounts receivable. But then at the other end, there are clients that aren't so creditworthy, and we put a lot more focus on the quality of their invoices, and we're more involved in monitoring the invoices and getting the supporting documentation and speaking directly to the debtors. So in the event that the client itself isn't around, at least we can still collect out from the end debtors. So that's more the full service factoring, and it's disclosed because we contact the debtors and we really make sure that our security is tight in those situations. And that structure is what allows us to advance funds to these businesses that may not be super strong from a credit perspective.
Okay. And then just on the acquisition side, I know you touched on it, you're always looking for opportunities, but I'm just wondering, is that more for books you can buy from somebody, or would it be more something similar to, the more recent acquisition where it comes with a book, but with some like nice technology pieces to go with it? Or is it maybe either one, if whatever might look attractive at the time?
I think that our capability now for invoice financing is great. And I don't feel like we need to add capability in any way. But to grow scale in the book would be attractive, because we have a great, efficient, capital light, low cost of funding warehouse. So the more scale we can put through that, the more we can get net revenue up and not add too much to our OPEX. And, that will increasingly pass down to profits, given the operating leverage that kicks in that scenario.
Okay, perfect.
But having said that, we're pretty careful with how much we pay. Like Time Air was a unique situation, and we would always want to buy acquisitions or make acquisitions that are EPS accretive.
Yeah. I think we've tackled all the questions with the audience here. Yes, we have. James, thank you very much for joining us. It was great to hear the story firsthand. And we look forward to the AGM update. I presume that'll be in November sometime.
That's right.
Okay, perfect. And
thank you very much, Mark. Thanks for the opportunity to speak to you all.
No problem. And we will leave it there. That rounds out our 2 events for this week. Thanks to all our presenters, and James especially as well for joining us for the first time. And we leave it there, and I wish everybody a good rest of their Friday. Thank you.